Have you ever considered what the quietest signals in the financial world are saying right now? Those that do not make headlines. The ones hidden deep within the system, where only those who pay close attention can see what's coming. The messages that don't yell, but rather whisper softly at first, until the echo is impossible to ignore. Because one of those signals has just done something amazing. Something has not been seen since 1929. And history tells us that whenever this particular event occurs, the world of banking, the world of jobs, and everything you know about money will alter in ways that most people are unprepared for. The yield curve. It sounds like a convoluted term coined by economists to confound everyone. But in reality, it is one of the most basic and brutally honest indicators we have. A calm chart that depicts the economy's heartbeat by plotting interest rates over time. One side has short-term rates, which are the cost of borrowing money for a few months. On the other hand, long-term rates are what investors require in order to lend their money over many years. Normally, that curve slopes upward because the future is unknown, and lenders want to be compensated for their patience. That's logical. That is good for your health. That is how it should be. However, when the system begins to twist under invisible pressure, when worry creeps in about what lies ahead, that curve flips upside down. Short-term borrowing becomes more expensive than long-term lending, and people would rather save their money for a decade than lend it for 6 months. This odd reversal is known as a yield curve inversion, and throughout modern history, it has preceded every major recession, crisis, and wave of panic that changed the financial laws. Imagine this. That inversion first appeared in April 1928, a year before the Great Depression. It was quiet at first, barely detected by anybody other than a few analysts. But it was there, whispering that the economy was overheating, that credit had become reckless, and that market exuberance had reached dangerous levels. Despite the warning, the stock market continued its upward trend. In fact, it rocketed nearly 50% higher once the inversion occurred. Newspapers dubbed it a golden period. The investors felt untouchable. Everything fell in October 1929. The Dow Jones lost 80% of its value. Unemployment soared to over 25%. The Roaring Twenties ended abruptly and violently. The inversion was not a coincidence. It was the silent warning before the world changed forever. Fast travel over the decades and you'll see the same beat repeating, almost like a haunting tune that never stops. The yield curve inverted in 1969, triggering a recession within 5 months. It happened again in 1973, just before an oil shock sent energy costs skyrocketing and consumer confidence shattered. The economy has shrunk. Unemployment increased. People queued up at petrol stations that had ran out of fuel. Then came 1979, another inversion, another downturn in 1981, when high interest rates destroyed company borrowing and people began to struggle with rising costs. Each time, the inversion was first. Recession came in second. But here's the unnerving part. Not every inversion causes instant agony. It sometimes arrives with an unusual delay. A misleading calm that leads everyone to believe the threat has passed. In 2006, for example, the curve reversed months before the housing bubble popped. For more than a year, markets rose. The economy appeared to be healthy. Unemployment rates were low. Financial experts triumphantly declared that the yield curve had lost its strength. However, when the bubble ultimately burst in 2008, the globe saw the greatest financial crisis since 1929. And now, once more, we find ourselves in that strange area between warning and consequence. The curve flipped in August 2022, sending a clear hint that danger was on its way. Instead of declining, the market rallied. Instead of deteriorating, the economy seemed to strengthen. Unemployment has been near historic lows. Consumers continued to spend. Tech stocks skyrocketed. Artificial intelligence is the new gold rush. People examined the statistics and stated, "See, this time is different." However, this time is different. Those statements are the most expensive words ever said in finance because they invariably occur shortly before the fall. The numbers become increasingly weird as you go deeper into them. Today's yield curve is not only inverted, but also deeply inverted. Much more than in 2006. Far more than in 1989. It even approaches the extremes last witnessed in 1929. That is, short-term money has become significantly more expensive than long-term money. The squeeze hits banks first, as they borrow short and lend long. Credit silently begins to dry up. Loans are becoming increasingly difficult to obtain. Consumers begin to rely on credit cards to cover daily expenses. Initially, it is not dramatic. It moves slowly, invisible, silent. However, pressure is gradually building behind the banking system's walls. And when it does ultimately release, it is always unexpected. Think about how this all fits together. When the curve inverted in the 1970s, oil costs skyrocketed, wages fell, and a recession followed quickly. The same tendency continued in the 1980s. However, back then, government debt was manageable, savings were larger, and there was room to spend our way out. Today, we live in a debt-ridden world. Governments, corporations, households, and everyone. When the next shock hits, there is far less room for rescue. The same medicine that previously treated recessions, cutting interest rates, printing money, and borrowing more now, has hazardous adverse effects. That is why this inversion is more than simply another warning. It might signal the start of a structural transformation in the global economy. Another fascinating link can be found by looking back to 1989. The curve inverted early in the year. Stocks rose for a year before entering a recession. That one was shallow due to the modest inversion. Today, the inversion is far deeper and has lasted significantly longer. History demonstrates that the deeper the inversion, the more severe the subsequent downturn. It's similar to the tension of a stretched rubber band. The more you pull, the harder it snaps back. Let us now return to 2006, as that example teaches a terrible lesson. Back then, the economy was booming. Home values were rising. The Federal Reserve felt confident. Unemployment remained below 5%, just as it is now. And behind it all, the yield curve screamed danger. 17 months later, the biggest financial crisis in modern history began. And most importantly, the duration between inversion and recession does not forecast how mild or severe the downturn would be. In reality, the opposite is typically true. The longer the delay, the more severe the final collapse, because it allows speculation to fester unchecked. That is exactly what occurred in 1928. The yield curve reversed more than a year before the Great Depression started. While the stock market continued to rise, people were ecstatic, just as they are today, about new technologies, soaring asset prices, and low unemployment. However, when the reckoning came, it was the most devastating collapse the world had ever witnessed. The similarities are uncanny. The inversion depth is currently nearly identical to that of 1928. The timing, the sense of optimism, the rejection, everything aligned in a way we hadn't seen in almost a century. So let's talk about what occurs next, which is the part that most people don't grasp. The actual injury does not begin with the inversion. The actual issue arises when the curve begins to steepen again. When short-term interest rates begin to decline, it is not because the economy is robust, but because the market perceives a problem and begins to rush into long-term safety. That is when recessions officially start. And guess what? That procedure has already started. The curve is beginning to un-invert and drift back towards normal, indicating that the countdown has quietly begun. Consider the economy to be a long line of dominoes that runs from Wall Street to Main Street. The inversion happens when the first one tips. For a while, nothing noticeable occurs. The dominoes are still balanced and immobile. The second one falls suddenly and unexpectedly, and the movement spreads. Credit has weakened. Spending slows down. Companies cut recruiting. The markets are in a panic. Eventually, the chain reaction becomes unstoppable. Every cycle concludes with a whisper that turns into a roar rather than fireworks. And here's the contradiction that makes it so dangerous. The stronger the economy appears while the inversion is in place, the bigger the fall is likely to be afterwards. Strength begets overconfidence, which produces risk. Prior to the crash in 1929, unemployment was approaching 3%. In 2007, it was 4.4%. Both times people said, the fundamentals are strong. Both times they were wrong. The yield curve tells the truth. It just informs us that the ground beneath our feet is moving. It is critical to recognize that the yield curve does not trigger recessions. It exposes them. It demonstrates that the flow of credit, The economy's lifeblood has reversed. Banks are no longer profitable from lending. Businesses do not expand easily. Consumers begin to back off. It's like watching the tide run out before a tsunami. Everything appears calm until you realize the water is receding because something big is approaching. And that is exactly what is going on right now. Corporate debt has reached unprecedented highs. Government deficits are increasing. Consumers are carrying record credit card debt at the highest interest rates seen in decades. Meanwhile, the cost of money has risen. The financial system is holding its breath, and the yield curve signals that something must give. The longer this imbalance exists, the sharper the correction will be. When the transition occurs, it will begin gradually. Perhaps a few bank failures? Perhaps increased defaults on consumer loans? Perhaps a slowdown in the housing market? Then, as in every previous cycle, it will accelerate. Confidence will be broken. Markets will drop. Central banks will rush to lower interest rates. But by then, the damage will be done. The trend has been repeated too frequently to be ignored. This time, the only variation is in scale. The inversion has deepened. The debts are greater. And the globe has never been more connected. This means that shockwaves will travel faster and impact harder than before. Crises, while alarming, also serve as resets. They rid the system of overabundance. They compel change. They motivate people to think creatively. The Great Depression paved the way for today's banking system. The 2008 financial crisis altered the global banking system. Whatever happens next is likely to change money once more, possibly in ways we cannot yet understand. The question is not if it will occur. It depends on whether you are paying attention before it happens. What can you do? History indicates that when the yield curve begins to normalize following a deep inversion, safety assets such as treasury bonds frequently outperform stocks. Cash regains its value. Individuals should limit risky debts, save more, and avoid speculation. Awareness is the most powerful kind of defense, because those who detect the signal early can prepare, while others who ignore it become victims. And now, when the curve returns to normal, we find ourselves at the same crossroads that our forefathers faced in 1929. The same silent signal flashes. The same confidence pervades the air. The same voices affirm that everything is fine. But history doesn't forget, and neither should you. The yield curve has done something unprecedented in nearly a century. And each time, the tale that followed transformed the globe. So, when the oldest and most reliable indicator in finance begins to duplicate the pattern that has preceded every major collapse over the last century, do you believe it will be different this time? Or do you prepare for whatever comes next? Because if history has taught us anything, it is that markets can deceive. Headlines may be misleading. Optimism has the potential to blind. However, the yield curve never whispers for no cause. And this time, the message couldn't be more apparent. So hit the subscribe and like button. Please share your ideas in the comments below. We'll see you there or in the future video. Just a reminder that I am not a financial advisor. This video is solely for educational reasons, and any outcomes are entirely dependent on your own choices. Thank you.